Welcome back to the Deep Dive. Today, we're really digging into a company right at the heart of the AI boom, Nebius Group N.V. That's ticker NBIS. We're looking closely at their Q3 2025 earnings.
Yeah, and there's just so much curiosity, isn't there, around these AI infrastructure companies. Their financials, well, they can be pretty complex, often showing what looks like, a contradiction.
Exactly. They spend billions now building out data centers, buying up GPUs
All powering AI.
to hopefully generate massive revenue streams down the line. But that whole process, it creates a lot of, let's call it financial noise.
It really does.
And that's precisely why we need a structured approach today. Our mission really is to cut through all that noise. We're going to use a specific five-part analytical framework, this comes straight from our source materials, to translate this pretty dense earnings release into insights you can actually use.
Right. The goal isn't just reporting numbers. It's about understanding what they mean for Nebius's future, finding those aha moments, you could say.
And we have to start with the big headline, the core contradiction that just jumps out from this quarter's report.
You said it. On one side, you've got this absolutely explosive performance indicator. Nebius reported, wait for it, 355% year-over-year revenue growth. I mean, that's just phenomenal top-line expansion, shows incredible demand.
Incredible. But you flip the page, look on the other side of the ledger, and you see, well, a potential problem. Their GAAP net loss actually widened significantly. It increased by 174%.
So, yeah, stunning revenue growth, proving the market wants what they sell. But the official loss nearly doubles. How does that happen? And maybe more importantly, why did the market seem to just shrug it off?
That is the big question, isn't it? Worth what, $4.8 billion in cash they have?
Something like that. The answer, it lies deep in the accounting, especially around infrastructure costs. And that's exactly what our structured approach, these 5 slides, will help us uncover.
Okay, so we'll move logically, right? Start with the headlines, then dive into the operations, check the balance sheet strength, and finish up with what management is saying about the future.
Sounds like a plan. Let's get into it.
All right. Now for slide 1, the at-a-glance scorecard.
Okay, slide 1. This is our starting point, and like you said, it highlights that contrast immediately. Massive growth up top, but a sacrifice on the bottom line. Let's look at that revenue number first.
So Nebius reported total revenues of $146.1 million for Q3 2025. Now compare that to Q3 2024, when it was just $32.1 million.
Right.
That's where you get that just staggering 355% year-over-year growth. It's not gradual, it's like a rocket launch.
And that 355%, it's more than just a big number. It's crucial validation, really. It tells you they successfully captured and served this, almost insatiable demand for AI infrastructure, for cloud services. The market's screaming for capacity. And Nebius showed they could deliver, at least compared to where they were last year.
But then, we pivot to the bottom line. And this can cause maybe some sticker shock if you're not used to these capital-heavy businesses. The net loss from continuing operations hit $119.6 million.
Oof.
Yeah. And that's up 174% from the $43.6 million loss they reported this time last year. So a much wider gap loss.
And normally you'd expect that widening loss to hammer the stock, right? Especially for a growth company.
Absolutely.
But the real story here, it wasn't just the loss or even just the revenue growth. It's about the market context, the strategic wins. We need to look at the Wall Street estimates, too, because interestingly, even that huge revenue number wasn't quite perfect on its own.
This is where it gets really fascinating. Okay, so they reported $146.1 million in revenue, but that was actually a miss compared to the consensus estimate on Wall Street, which was $155.73 million. So they came in about $9.6 million short of expectations.
Right, and conventional wisdom says high-growth stock misses revenue consensus, stock goes down.
Yeah, immediate punishment.
Yet, Nebius shares actually rose. They were up about 1% in pre-market trading right after the announcement. So what gives? Why did the market ignore that $9.6 million miss?
It's because something else completely overshadowed the quarterly numbers. The headline that grabbed everyone's attention said it all, really. Nebius Inc.'s 3BA AI infrastructure deal with Meta, Q3 revenue misses estimates.
Boom, that Meta deal. That became the entire story of the quarter. For a company like Nebius, building out this massive infrastructure, landing a multi-billion-dollar, multi-year contract with a hyperscaler like Meta.
Especially after they already had a similar deal with Microsoft.
Exactly. It's just undeniable strategic validation. It proves they're in the big leagues.
Yeah.
So a temporary, relatively small revenue miss, it becomes almost irrelevant when you've just locked in that kind of future revenue visibility.
So the market's saying, okay, the $146 million this quarter is fine, but we're valuing you based on the billions you just secured for the next 5 years.
Precisely. The market sees these contracts as proof Nebius can operate at the scale needed by the absolute giants of the tech world.
Okay, but let's circle back to that widening loss. The market might have ignored it because of Meta, but we need to understand the mechanics. How does 355% revenue growth lead to a 174% bigger loss? It feels wrong.
It does feel counterintuitive, and, looking deeper, their total operating costs actually grew slower than revenue. They were up 145% to $276.3 million.
Right. So if costs grew slower than revenue, why did the loss get so much bigger, so much faster?
The answer is buried in one specific line item under operating expenses. It's a big one, and it's largely non-cash. Depreciation and amortization. DNA. This is where the sheer scale of their recent investments hits the books.
Okay, DNA. Let's get the numbers.
They are staggering. DNA expense ballooned by 321%. It jumped from $23.5 million in Q3 of 24 to a massive $99.0 million in Q3 of 25. $99 million.
Wow. So that more than tripling of depreciation, that's the main thing driving the bigger gap loss.
It's the primary driver, absolutely.
We should probably make sure we're crystal clear on what DNA actually is. It gets confusing because we call it non-cash, but it represents real money spent at some point.
That's a great point. Think of it like this. Nebius goes out and makes a huge investment. They buy thousands of super expensive, cutting-edge GPUs. They build the data center to house them. That's a massive cash outlay, right? Capital expenditure.
Billions, potentially.
But accounting rules, GAAP rules, say you can't just expense that entire $1 billion in the quarter you spend it. These are long-term assets, so you have to spread the cost over the asset's expected useful life. For high-end tech like GPUs, maybe that's, 4, 5, 6 years.
Okay, so if they spend $500 million on gear this year, they don't take a $500 million hit to profit immediately. They expense, say, $100 million this year, $100 million next year, and so on.
Exactly. Depreciation is that annual accounting charge. It reflects the using up or the loss of value of that asset over time. Or maybe better put, it's allocating the cost of that asset to the periods where it's generating revenue. The cash already left the building when they bought the GPU. The DNA charge is just the bookkeeper catching up, reflecting the cost of using that gear now.
And that massive 321% spike in DNA tells us they must have recently deployed a ton of new, very expensive GPU infrastructure.
Precisely. It's the direct accounting consequence of their huge build-out.
So bottom line on the loss.
Yeah.
It's not necessarily reflecting poor day-to-day operations or uncontrolled spending. It's the accounting system reflecting the immense cost of building the capacity needed for those huge deals, like the Meta one.
Right. It's a front-loaded cost, it's planned, and it's completely tied to this capital-intensive land grab strategy they're pursuing. You have to build it before they will come, essentially.
And the company basically confirms this, right? Saying the DNA increase was driven by significant ramp-up in investments in GPU-related capital expenditures.
And related data center hardware. It's the cost of their ambition, plain and simple. They take the accounting hit now to secure those big, hopefully high-margin contracted revenues later.
Okay, that makes sense. And this gap, this difference between the official accounting loss and maybe the underlying operational reality, that leads us perfectly into the next part of our analysis.
Yep, digging into the real engine.
Moving to slide 2, the engine of profitability.
All right, slide 2. So if slide 1 laid out the problem, that widening gap loss, slide 2 really provides the counter-narrative, the justification. It's all about understanding the difference between the official gap story.
What they have to report legally.
Right. And the non-gap story, which is closer to how management sees the core health of the actual day-to-day business.
Okay, let's stick with the official gap numbers first. The loss from operations for Q3 2025 widened, as we said, to $130.2 million. It's definitely a bigger loss than the $80.6 million they reported last year.
But now, compare that gap loss to the non-gap picture. And for this, we look at their adjusted EBITDA. Here, the story is completely different. The adjusted EBITDA loss actually showed massive improvement. It shrank by 89%.
89%.
From what to what? It went from a loss of $45.9 million in Q3 24 down to a loss of just $5.2 million in Q3 25. Basically, near break even on that basis.
Wow. Okay, going from a $130 million gap operating loss to just a $5 million adjusted EBITDA loss?
Yeah.
That's a world of difference. We absolutely had to break this
Yeah.
down. What exactly is adjusted EBITDA, and why is that tiny $5.2 million loss number so much more appealing to investors looking at operational health?
Right, so EBITDA stands for earnings before interest, taxes, depreciation, and amortization. The adjusted part means the company has also stripped out or added back other specific items, usually non-cash expenses or things considered one-off.
Like what?
Well, management uses this metric to show how the core underlying business is performing, separate from decisions about financing, like interest payments or government stuff like taxes, or, crucially here, those big past capital investment decisions reflected in D&A.
So Nebius takes its big gap loss, and then it adds back certain things. We know that $99 million in D&A is the biggest add back from slide 1. What else typically gets added back?
The other really common big one is stock-based compensation, or SBC. This is another non-cash expense. Companies give stock options or shares to employees as part of their pay package. GAAP requires them to record the estimated value of those options as an expense on the income statement, even though no actual cash is going out the door for that specific compensation in that period.
Okay, but we should probably mention the criticisms, right? Non-GAAP metrics like adjusted EBITDA sometimes get a bad rap.
Oh, absolutely. It's a fair point. Critics argue that management gets to pick and choose what they adjust out, what they want investors to ignore. And sometimes, yeah, that can paint an overly rosy picture.
Like, SBC might be non-cash now, but it's a real cost to attract talent, and it dilutes existing shareholders down the road when those options turn into shares.
Exactly. You can't completely ignore those costs forever. However, in a case like Nebius right now, where that DNA charge is so massive and it's so clearly tied to building these essential growth assets, well, adjusted EBITDA does provide a pretty useful, I'd say legitimate lens into how efficiently they're actually running the business day to day from a cash perspective.
Okay, let's connect those numbers directly then. We had the $130.2 million GAAP operating loss. You add back the $99.0 million in non-cash D&A.
Right. Gets you most of the way there.
And that alone basically wipes out 3/4 of the loss, bringing it down to, what, around $31 million? Then you add back the SBC, maybe a few other smaller adjustments, and bam, you landed that remarkably small, almost break-even, adjusted EBITDA loss of just $5.2 million.
And that synthesis, that bridge between the GAAP loss and the adjusted EBITDA, that's the key takeaway for the underlying health of the business model right now. The fact that their core operations on this adjusted basis are basically breaking even while growing revenue at 355% and absorbing huge overhead, it strongly suggests the model is scalable and fundamentally sound.
So the massive GAAP loss is the necessary accounting pain for building that potential $7 to $9 billion future revenue stream we'll talk about later.
That's the argument, yes. It proves the cash-generating part of the operation is actually improving dramatically.
And this ability to scale, this improvement, it comes down to a concept we talk about a lot.
Right.
Operating leverage. How did Nebius show that they're achieving that this quarter?
Operating leverage. Yeah, that's the magic word for any cloud or infrastructure player. It's that point where your revenue starts growing much, much faster than the costs needed to support that revenue.
Because the big costs are fixed, right? Building the data center, buying the first batch of GPUs.
Exactly. That's your huge fixed cost base. Once that's in place, the cost of adding the next customer or getting more usage out of the existing gear, it's relatively small. Your margins on that incremental revenue become really attractive.
So where's the proof in Nebius's numbers?
It's in a metric they reported. Total operating costs and expenses as a percentage of revenues. You want to see this number going down fast. And boy, did it ever. It plummeted from 351% back in Q3 2024.
351%.
Yeah, really high, down to 189% in Q3 2025. That kind of improvement in just 12 months is, well, it's profound.
Let's use that dollar analogy again to make it really clear what that means.
Good idea. So back in Q3 24, when that ratio was 351%, Nebius was deep in investment mode. To earn just $1 in revenue, they had to spend $3.51 in total operating costs. They were losing a lot on every dollar that came in, basically building the plane while flying it. Fast forward to Q3 25, that ratio drops to 189%. Now, to earn that same $1 in revenue, it only cost them $1.89 in operating expenses. They've almost halved the cost required to generate each dollar of revenue.
It is a massive efficiency gain. And it's tangible proof that the huge capex strategy, the one causing the big DNA charge and the gap loss, is actually working. It's making the operation itself much more efficient as they scale up.
Exactly. As they onboard big clients like Meta onto that newly built capacity, you'd expect that 189% figure to keep falling, heading down towards 100%, and then eventually well below it, which is where profitability lies.
It really validates the strategy, doesn't it?
Yeah.
They took the risk, spent the billions on fixed assets, and now they're starting to see the payoff in rapidly improving operating leverage and nearly break-even adjusted operations.
It shows the model is working as designed, even if the DAP numbers look scary at first glance.
Okay, that gives us a lot more confidence in the overall business model. Now let's look inside the Nebius empire. Which parts are actually driving this engine?
Good question. Let's move to the segments.
Let's analyze the individual components in slide 3, the engine room business segment performance.
Right, so Nebius Group isn't just one single thing. It's technically a group of companies, but we need to quickly figure out, where's the money really coming from. The consolidated results cover 3 main segments. There's Nebius itself, which is the core AI infrastructure business.
Okay.
Then there's Everyday, which is their autonomous vehicle technology.
Right, the moonshot.
And Triple Ten, which is their EdTech platform.
And the answer seems pretty clear-cut, based on the report. The core AI infrastructure business, Nebius proper, accounts for approximately 90% of total group revenue in Q3.
90%. That's the critical piece of information here. For anyone analyzing this company as an investment, Nebius Group is effectively a pure-play AI infrastructure company right now. Yes, the other segments exist. They offer some optionality, maybe some future value. But the core AI segment dictates pretty much everything. The overall financial path, that massive growth rate we saw, and ultimately how the market values the company, that 355% group growth. It's basically the AI infrastructure division's growth.
Okay, so what about those other bets then? Triple Ten and Everade. Are they valuable assets or just, distractions?
Well, Triple Ten, the EdTech business, actually looks like a really solid performer. The report says it continued to deliver strong revenue growth of 100% year over year.
Wow, 100% growth in EdTech. That's a tough market. It suggests they're doing something right there, executing well.
It really does. It shows good execution, maybe a strong product market fit. And while it's obviously small compared to the main AI business, it proves management isn't just a one-trick pony. They can run other tech-enabled growth businesses successfully. It looks like a valuable, high-performing asset within the group.
Okay, then there's Everade, the autonomous vehicle unit. This sounds like the classic R&D sinkhole, right?
Well, yeah. It's definitely the long-term, capital-intensive moonshot. And the report confirms that for Q3 2025, its revenue contribution was simply immaterial, basically zero or close to it. So yes, it's burning cash, needs constant development, and isn't bringing in revenue yet.
Which logically leads to the question, why is Nebius, a company raising and spending billions on GPUs, still holding on to this cash-draining AV business? Wouldn't it make more sense to sell it, focus entirely on AI?
You'd think so, right? But this is where the strategic move they announced this quarter comes in, and it's actually quite clever. They found a way to basically de-risk Everade while keeping a potential upside.
Ow.
They announced a strategic partnership with Uber. And this isn't just a handshake deal. It includes a significant strategic investment from Uber, plus other potential commitments, totaling up to $375 million into Everade.
Okay, so Uber's putting money into the AV venture.
Exactly. This is brilliant portfolio management, really. Nebius spent the initial capital, incubated this incredibly complex and expensive AV technology, taking on that early R&D risk. But now, Uber, arguably one of the biggest potential users of autonomous vehicle tech for ride-sharing and delivery, has stepped in. They've validated the technology by investing. And crucially, Uber is committing substantial cash, up to $375 million, to help fund its future development.
That changes the dynamic completely. Everade stops being just a drag on Nebius's cash flow.
Precisely. It's no longer solely reliant on Nebius's core AI cash generation to survive. It's now a validated asset, co-funded by a major strategic partner who has a vested interest in its success.
So Nebius gets 2 big wins. External validation, which probably increases Everade's standalone value, and more importantly for the core business, it shifts a big chunk of the future funding burden onto Uber.
Exactly. It lets Nebius management keep their eye on the prize, the 90% AI core, and focus their own massive capital spending there, while still holding on to a potentially very valuable lottery ticket in Everade, but now with much less financial risk attached. It's smart capital allocation.
Okay, and speaking of capital allocation and funding these huge ambitions, that takes us right to the balance sheet. None of this works without serious financial firepower.
Absolutely. You need the foundation to support the skyscraper.
Shifting focus to the balance sheet in Slide 4, financial strength and shareholder actions.
All right, slide 4. This is where we see the financial bedrock supporting this sky-high ambition. If you're going to tell the market you're aiming for $7 to $9 billion in revenue soon, you better have a balance sheet that can withstand spending billions every year to get there. A fortress balance sheet, as they sometimes say.
So let's start with the most basic measure, cash. How much do they have on hand? As of September 30th, 2025, Nebius reported $4,794.8 million, so just under $4.8 billion in cash and cash equivalents.
$4.8 billion. That is a serious war chest. In this environment where everyone's scrambling for the latest high-end GPUs, having that much cash readily available is a huge operational advantage.
How so?
Well, it likely allows them to jump on opportunities, secure scarce hardware perhaps faster, or maybe on better terms than competitors who might need to arrange financing first. It lets them effectively buy market share, buy capacity ahead of the curve.
Okay, $4.8 billion in cash. But we need to look at the other side, too, debt. The report shows $4,090.8 million in non-current, so long-term debt. And total shareholders' equity is $4,810.8 million.
Right, so let's do a quick leverage check. That's crucial for assessing risk. If we take the long-term debt, $4.09, and divide it by the shareholders' equity, $4.81, we get a debt-to-equity ratio of about 0.85.
0.85. How should we interpret that? Is that high, low, average?
For a company in this kind of hyper-growth phase needing aggressive financing, 0.85 is generally considered pretty manageable, quite healthy, actually. It means for every dollar of equity value on the books, they have about 85 cents in long-term debt.
So they're using debt to fuel growth, but not excessively.
Exactly. They're leveraging the balance sheet, likely using mostly convertible notes based on other disclosures, which helps accelerate growth. But they don't seem leveraged to the point where, say, a sudden spike in interest rates or a mild recession would immediately threaten their solvency.
You mentioned convertible notes. That's debt that can turn into stock later, right?
Correct. It's often cheaper debt initially because the bondholder gets that potential upside if the stock price goes way up. But it carries the risk of future dilution for existing shareholders if conversion happens. If the stock doesn't perform, though, the company is still left servicing that debt. So that 0.85 ratio suggests they're trying to strike a calculated balance.
Okay, healthy cash balance, manageable debt. Now let's connect this back to the spending. We talked about the D&A charge being huge. What was the actual cash they spent on equipment this quarter to eventually cause that charge?
The number is just breathtaking. Capital expenditures, or capex. The line item purchases of property, plant, and equipment shows they spent $955.5 million, nearly $1 billion.
In one quarter.
In one single quarter. Just on buying GPUs, building data centers, the physical stuff.
That is the land grab strategy in cold hard cash, isn't it? Deploying capital at basically a $4 billion annual run rate just to acquire the physical assets they need to generate that future revenue.
It confirms they are absolutely pedal to the metal, executing on their plan to build market share and capacity now.
And where did all that cash come from? The spending is huge.
Well, the cash flow statement shows how they funded this earlier in the year. In the first 9 months of 2025, they raised $4.16 billion, primarily from issuing those convertible notes we talked about, and another $1.15 billion from selling new equity securities, so selling stock.
So the strategy is clear. Raise billions through debt and equity, keep a huge cash pile ready, and then deploy almost $1 billion every quarter to lock down those crucial AI assets.
That's the playbook. But to keep this pace up, they need ongoing access to capital, flexible capital preferably. Which brings us to the new shareholder action they announced.
Right, the ATM program.
Yes, they announced a new at-the-market, or ATM, equity program. This allows them to sell up to 25 million additional Class A shares over time. This is a really important tool for companies in this phase.
Okay, let's make sure we explain what an ATM program is, because this directly affects current shareholders.
Absolutely. Think of an ATM program like a funding faucet that the company controls. It lets them sell newly issued shares directly into the stock market gradually at whatever the current market price is.
So it's different from a big, splashy secondary offering.
Very different. A traditional secondary offering dumps a large block of shares all at once, Usually requires underwriters, roadshows, and often happens at a discount to the market price. An ATM is much more flexible, lower overhead. Management can decide, okay, we need cash for a GPU order this week, turn the faucet on, sell some shares. Then maybe next week, if the price dips, they turn it off.
And we need to stress, the main point of an ATM is to raise money for the company. It's not about returning capital to shareholders.
Not at all. It's pure growth funding, and it comes with one unavoidable consequence.
Dilution.
Dilution. Every single share they sell through that ATM increases the total number of shares outstanding. That means each existing shareholder owns a slightly smaller piece of the pie, and their claim on future earnings per share gets reduced proportionally. It's the trade-off you make for funding this kind of incredibly capital-hungry growth without piling on potentially unsustainable levels of debt.
How did management talk about this? It's always a sensitive topic for investors.
They acknowledged it directly. They basically said they need the funding flexibility, but they also stated they will remain dilution sensitive.
Dilution sensitive. What does that likely mean in practice?
It's language meant to reassure investors. It suggests they understand that dilution isn't popular, and they intend to use the ATM carefully. Maybe only activating it when they have specific immediate capital needs, or ideally when the stock price is trading at a high enough level that they can raise the cash they need by selling fewer shares, minimizing the dilutive impact.
Okay, so slide 4 really confirms the whole financial picture. They have the cash fortress, the debt seems under control, and they now have this flexible ATM tool ready to keep fueling that nearly billion-dollar-a-quarter spending habit. They appear fully financed to chase their huge goals.
The financial engine seems primed and ready.
All right, we've looked at the headlines, the profitability engine, the segments, the financial foundation. Now let's bring it all home by looking at what management is actually forecasting for the future.
This is where they tie it all together and point investors forward.
Finally, we bring it all together in slide 5, the road ahead management's outlook and key takeaways.
Yes, slide 5. This is really the culmination of their narrative for the quarter. Management was quite skillful, I think, in using this earnings release not to get bogged down defending the $9 million revenue miss.
Right.
But instead to paint a really clear, really bold, forward-looking picture. They basically directed everyone's attention straight to 2026.
The CEO, Arkady Veloz, had that key quote, didn't he? Something like, 2025 has been a building year.
We have successfully laid the foundations for an outstanding 2026. Yeah, it's a classic message. Don't judge us on today's construction site noise. Look at the amazing skyscraper we're building.
He's telling investors that the current gap loss, the huge capex, that's just the cost of pouring the foundation for future success. And they back that up with some serious proof points, things that really changed the market's perception of the quarter. First, that strategic validation we keep coming back to.
The Meta deal, that new $3 billion 5-year agreement coming on the heels of the similar earlier deal with Microsoft.
Landing both Meta and Microsoft as major long-term customers, I mean, that puts Nebius in a very, very small elite club of infrastructure providers, doesn't it?
It absolutely does. It says they have the scale, the technical chops, and crucially, the trust required to handle the massive, complex AI workloads of the world's biggest tech companies, the hyperscalers. It's instant global validation of their capabilities and market position.
Okay, so that's huge validation. What was the second major piece of forward-looking evidence they provided?
It was about their physical capacity build-out. They didn't just give vague, optimistic guidance, they put hard numbers on it. They significantly raised their targets for infrastructure capacity for 2026.
Raised them by how much?
By 150%. They're now targeting approximately 2.5 gigawatts, or GW, of contracted power by the end of 2026. Their previous target was 1 GW.
2.5 gigawatts. That sounds like a lot of power. Can you put that in context?
It's an enormous amount of electricity, purely dedicated to running AI infrastructure. Just for a rough comparison, 2.5 GW is enough power for maybe 2 million typical homes. So boosting that target by 150%, that signals immense confidence, driven directly by the revenue visibility they must be getting from these huge new contracts. They wouldn't raise the target unless they were sure they could fill that capacity.
So massive validation from Meta and Microsoft and a huge increase in their planned physical build-out.
Exactly. And based on that confidence, based on the capacity they're racing to build, they drop the mic with the ultimate revenue target.
Okay, the big number. What is it?
The ultimate target. Nebius is now forecasting they will achieve an annualized run rate revenue, or ARR, of between $7 billion and $9 billion by the end of 2026.
$7 to $9 billion. Let's just pause there. They just reported quarterly revenue of $146 million.
Right.
They are guiding for an annualized run rate just over a year from now that is something like 50 to 60 times higher than their current quarterly pace.
Yeah.
That's not just hypergrowth. That level of acceleration, if they hit it, it kind of redefines expectations for AI infrastructure growth. How do they even justify forecasting such a massive leap?
Well, the justification rests on that combination of factors we've discussed. The operational efficiency improvements we saw in slide 2, the operating leverage,
The huge strategic validation from Meta and Microsoft giving them revenue visibility.
right, and the aggressive capex detailed in slide 4, proving they're actually building the physical capacity, that 2.5 GW target, needed to deliver on multi-billion-dollar contracts they've either already signed or are clearly confident they will sign very soon. The capex is the enabler. The big contracts provide the confidence for the forecast.
Okay, it's a bold, interconnected story. Let's use our framework now to boil this all down into the key takeaways. 4 core conclusions for listeners to grasp.
Sounds good. Takeaway 1. Market focus is forward-looking. That small Q3 revenue miss completely overshadowed basically irrelevant noise in the big picture. The $3 billion Meta deal was the defining event. It provided immense strategic validation and secured a huge chunk of future revenue. For these kinds of stocks right now, that long-term visibility trumps minor short-term fluctuations.
Okay, takeaway 2. The GAAP loss is a planned investment cost. That 174% widening of the official net loss isn't a sign the business is failing. It's the calculated, expected cost of building an empire. The nearly $1 billion spent on capex this quarter is what drives the high D&A charge, but it's also the essential fuel needed to even aim for that $7 to $9 billion revenue target in 2026. No pain, no gain, essentially.
Exactly. Takeaway 3. The business model is scaling and highly functional. The underlying operational data confirms this. We saw that dramatic improvement in operating leverage. Remember, the cost to earn $1 dropping from $3.51 down to almost nothing, just $5.2 million. This proves the core business model works and scales incredibly well once the heavy lifting of building the infrastructure is done.
All right, and takeaway 4. The growth plan is fully financed and secured. This ambitious, high-risk strategy seems well supported financially. They have that huge $4.8 billion cash reserve. Their debt level looks manageable with that 0.85 DE ratio. And now they have the flexible ATM program ready to provide ongoing funding. They appear to have the financial tools needed to acquire the GPUs and build the 2.5 GW capacity they're targeting.
So, yeah, the final narrative for Q3 25 becomes pretty clear, doesn't it? This quarter wasn't really about the $146 million they booked. It was all about the massive commitment they made and secured funding to build towards that $7 to $9 billion revenue run rate by the end of 26.
Funded by billions in capital raises, validated by huge contracts from tech giants.
And with a widening accounting loss simply being the recognized cost of admission to play at the absolute highest level of global AI infrastructure.
It truly is a phenomenal scale of ambition.
Yeah.
But it also requires, as we've touched on, a phenomenal tolerance for risk, both from management and from their shareholders.
Which leads us to that final thought for reflection. Given the almost unbelievable level of capital spending, nearly $1 billion just this quarter, and the company openly signaling they'll use the ATM, accepting the shareholder dilution that comes with it, the big question for you, the listener, to ponder is this. Is that promise, that target of $7 to $9 billion in ARR by late 2026, is that a big enough potential reward to justify the incredibly high cost of ambition shareholders are paying today?
A very pertinent question to think about. Okay, before we wrap up, we need to include our standard disclaimers for this kind of financial deep dive.
Right. Financial disclaimer. This report is strictly for informational purposes. It does not constitute financial, investment, legal, or tax advice. Nothing herein is a recommendation or solicitation to buy, sell, or hold any securities. All investment decisions must be based on your own research and made in consultation with a qualified financial professional. Please do your own homework.
And the AI disclaimer. This report was generated by an artificial intelligence model. It integrated data directly from Nebius Group's official Q3 2025 earnings press release, along with publicly available market data sourced through real-time web searches. While the AI aims for accuracy and follows strict data protocols, errors or omissions might still occur. All information, especially financial data and calculations, should be independently verified by you before making any decisions based on it.
Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our library of S&P 500 stocks and NASDAQ 100 library we are building out, and also get priority requests for company deep dives.